Hello everyone and welcome to this webinar on three particular technical analysis tools that I particularly use. Now, a lot of people hear about the MACD or the moving average convergence divergence, the stochastic and the RSI, and they often wonder, well, what are they? Should I use them? How do I learn about them? Is the way to learn about them from the textbooks the best way? How come they are wrong so often? How does professionals and how do professionals use them? What I want to do in the interests of efficiency and effectiveness is in 1 hour give you what I think everything you need to know in practical terms on how to use them, how to combine them, what their weaknesses are, and actually, most importantly, how I actually use them and why they're my favorite indicators. And this would then put to rest your concerns or your questions, your queries about these three very important indicators, hopefully save you lots of time and allow you to make lots of money, if not lots of money, at least save you from losing lots and lots of money. So that's my aim with this webinar today. And what I'm going to kick off with is first and foremost the principles behind all of these indicators. It's really important that we understand what the thinking behind them is. Why do they in actual fact exist? Then I'm going to take you through each of the indicators in turn, and then most importantly show you how to combine them, what's relevant and what isn't. In actual fact, virtually 99% of what you read in the textbooks about these is irrelevant. And of course, you'd expect that to be the case. You'd expect it to be the case because if what was in the textbooks was everything we could apply, then the textbook writers would be out there just using it all the time, way too busy. In actual fact, the reason what's in the textbooks isn't relevant is not because it's wrong in and of itself. It's because it used to work when it wasn't widespreadly known. And the more well-known these things become, funnily enough, they don't reinforce each other. They virtually destroy each other in their applications. And that's why there is, in actual fact, a fundamental truth and an ability to use these. It's just not the way in which it's done in the textbooks, and I'll show you actual evidence of that and when it works, how it works. But in order to do that, as I said, we need to start at the start, which is what's the principles that these indicators are predicated upon. Why do they exist? For what purpose do they exist? So starting off with all of that, the first thing I actually need to do is first and foremost is to give you the obligatory important notice that none of this should be considered as financial advice. In actual fact, we're not even going to be talking about specific stocks. So this is one webinar where I can pretty much skip all of this. It's just purely educational. We're not talking about specific stocks. We're not talking about spread betting and margin products. We're not talking about foreign exchange. What you should know, should any of those issues come up, is that these are margin leveraged products. You've always got to make sure that they're suitable to yourselves because you could lose more money as you could in trading than you might start off with, and that this can be a risky endeavor. And our job in educating you is to ensure that we try and limit that risk as much as possible, hopefully try and remove it to the largest possible extent. But one thing that I will never do is promise you your own private island and private jet off the back of a few hours of education. Just to give you my credentials, I do this at every webinar. I've written lots of books, and this is a list of some of the paying companies. These are the companies which have paid for my company's services in advising and instructing their investor groups, their private investors, their private clients. So I'd like to think that they've had trust in me, and therefore you should have trust in me as well. Now, what's the reason behind why we ever even look at momentum indicators? As I said, I'm going to start at the beginning. And these indicators, the MACD, the stochastic, the RSI, which I'll explain in detail, they're all in the category of momentum indicators. So what is it? Why do they exist? What's the reasoning behind them? Well, to some extent, it's because markets can do this. Markets can, for very prolonged periods of time, if you're just a buy and holder, buying on fundamentals, could end up getting you nowhere over very long periods of time. You'll notice that I've stopped at 74. I ran out of space on the screen. I could have gone on, and some of you will have lived through, as I have, some very painful periods personally when the markets have dropped significantly. I fortunately wasn't investing in the 73 to 74 period, but we've seen replications of these moves. So why are we interested in momentum indicators? Well, it's because they're used over far shorter periods. When you look at any of these time frames, you will always have periods when the markets have, over shorter periods, actually moved upwards. Or if they've moved downwards, the momentum indicators in the short term have given us the opportunity to get out of the market or even short it, if that's the way we're inclined, but certainly get out of the way. And in between, even during the period 1929 to 1932, you can see periods where the market has gone up. And that's what we're trying to do with momentum indicators. We're trying to undertake the relatively risky strategy of timing the market. Now, you might say, how can you say relatively risky when look at what buy and hold's doing? It's just falling. Well, I say relatively risky for this reason. That's how it's always perceived. That's how it's conveyed. Let's see if we can de-risk it somewhat, because for all the wonderments of the buy and hold people, these are some of the periods where we've actually had our investments, if not decimated, certainly reduced by the order of 50% in some cases. And it's taken a heck of a long time to regain those things. It's happened before, it'll happen again. So what are we trying to do with these momentum indicators? In a way, this is I just picked a random period from history. I didn't just want to pick what's happened over the last month or the last week or the last year. And the reason for that is that these things keep on happening. And I picked a random period and a random security, and wanted to convey, this is what we're trying to do. We're trying to enter and go long, where I've marked the chart with the letter O, and we're trying to exit, where I've marked it with the letter P. That's all. We're just trying to do that in and out, and make money along the way. Now, to try and do that without any kind of indicator, momentum indicator or otherwise, becomes rather difficult for us. We need some kind of measure and some kind of methodology to give us buy and sell signals, entry and exit signals. The problem is we pick up a textbook, we hear about these indicators, we follow them, and then we think, how come it's not working like the textbook said it would? Or how come it only works like that half the time? Well, a coin works half the time as well. Why am I bothering to spend all my time looking for this indicator? So then you go and spend your time looking for even more indicators, you get even more different books, and you can never seem to find the holy grail, which gets you better than 50% correct. Indeed, even if you're correct 6 times out of 10, you find on the 4 occasions that you're wrong, you've lost all the profits you made on the 6 times you were right, and then some as well. So the market just keeps you sufficiently interested by giving you sufficient profits now and again to make you think it's worth endeavoring with. We need to be better than that. We need to get a return on our time and on our investments such that we are more accurate and we're making profits, of course. So if that's our aim, how do we go about doing it? Let me show you a stylized version of the markets. I want you to focus, first of all, on the graph at the top left-hand corner. That's just a simplistic example of a price move. Price goes down, price goes up. That's all it is. That's all. Top left-hand corner. Yep, it goes down and then it's gone up. Nothing complicated. Sort down. And this happens every day. It happens every second, every minute, every hour, every day, every month, every year. If we have something, might be a momentum indicator, might be something else, we have something, anything, which is based on giving us a buy signal, the danger very often, and the problem with many indicators, is that we get an entry signal too late. What's the point of getting in after the market's risen? We'll all have done this with the markets. We've all got in, and then virtually the next day, as if the market knows what we're going to do, as if it's out to get us, or the broker's out to get us, all of a sudden the stock falls. So I want you then to look at the figure beneath that. I want you to look at the bottom left-hand corner. You see the price move from X to Y to Z. Nice smooth move. Now, In actual fact, if you look at the top right-hand corner, we don't know when it just starts moving up slightly from X to Y. Very often, we do not know whether it's going to do the move from X to Y to Z, as in the bottom left-hand corner, or it'll go from X to Y and then down again. And that's the fundamental problem with trading. When you see the price move up a little bit, you simply don't know whether it's going to continue going on or whether it's going to move lower. The problem with indicators is that they could give us an entry too late. And the problem with prices is fundamentally we don't know when it's gone up a little bit whether it's going to continue or whether it's going to turn around. So what we're trying to do with our indicators is find one which gives us a signal at point Y, so not too late. That's the first thing, not too late. That's the first thing at point Y on price movements which are going to be like the bottom left-hand corner and not the bottom right-hand corner. In other words, first thing, it's got to be signals which are not too late, so they get us in at point Y. That's the first important thing. And this is how we measure the quality of a signal. And the second most important thing is that when it has got us in at point Y, it's kept us out of trades of the type which are in the bottom right-hand corner where the price just then falls immediately afterwards. It fizzles out, doesn't actually have any strength, doesn't have any momentum, and finds us ones which are like the bottom left-hand corner. Now, why is this so important? Well, obviously it's important because it'll make us money, but actually it's important because the money you make in trading comes from two sources. It comes from the trades you make, like those in the bottom left-hand corner. You get in at point Y and they go up to point Z. It also, incredibly importantly, probably more importantly, comes from the trades you don't make. And if you can avoid, no matter how good you are at the moment, what if I could show you some indicators which would, if nothing else, if absolutely nothing else, kept you out of a few of the types of trades which you see in the bottom right-hand corner. Let's say at the moment you're really good with how you're doing. Thank you very much. You're right 6 times out of 10 in your trading. You're happy. You're making a little bit of profit or you're breaking even. What if I could, out of those 6 out of 10, just remove 1 or 2 trades which were like in the bottom right-hand corner? Then you might be right 7 times out of 10. That's bound to increase your profitability or turn you from loss making into profit making. Either way, it's got to be good for you. And that's merely if I'm just removing 1 bad trade out of 10. What if instead of removing 1 bad trade out of 10 from what we're about to learn, we actually increase the number of quality trades? So how do we do it? This is all general talk. The fundamental principle behind all momentum indicators is this. One day, all these traders were sitting around, they're looking at the way price moves and the fact that they go up and they go down, they go up and they go down. And then somebody rather cleverly said, it's a bit like a ball. Throw a ball in the air, goes up, comes down. But with a ball, we know when it's going to come down even before it starts moving downwards, because the laws of physics and mathematics allow us to predict exactly when a ball is going to fall, even at the point where it's still rising. So you throw a ball in the air, maths and physics will tell you before that ball even starts falling at exactly the time and space and exactly at what point it will stop and reverse direction. So these mathematicians then said to themselves with trading prices, what if we could do the same with trading prices? What if we didn't have to wait until the prices fell, so we didn't get in too late because we waited too long and then the price had already fallen? Or we didn't get in so early that in actual fact they reversed and we got in too prematurely? What if, rather like a ball, prices too have momentum because they have similar patterns, characteristics as a ball? What if we could, whilst the price is still rising, work out at what point it's going to turn, and therefore get out near the top before the price falls and changes direction. All fine in theory, very clever. How do you do that with share prices? That's the thing. How do you actually give effect to that notion? So they then started off with, well, let's look at what is a share price. A share price is depicted by these types of bars. We're all familiar with them. I'm going to tell you something about these bars that you don't know. So you're familiar with them. The open is the little horizontal line that goes in from the left-hand side into the vertical line. The high for the day or the minute or the second, or the 5 minute or whatever your setting is, or the week, is depicted by the height of the bar, and the low point of the bar is the low for the period in question, and the close is the horizontal bar going to the right-hand side. We're all familiar with this. And as you can see, you could have a close above the open, and you could have an open below the close, obviously, depending on how the trading's gone. So what's the equivalent of a price move? What's the equivalent of a ball move with prices? So they looked at this, these mathematicians and traders, and they said, you know what we've noticed? When a price has a lot of momentum and it's rising fast and there's a lot of demand, it tends to close near the high for the period, because you'd expect that to happen. There's a lot of momentum, there's a lot of interest. Of course it's going to close near the high. So it's going to look like the left-hand bar. But the other thing we've noticed is when that momentum fizzles out, the price could still go up, but it'll tend to close near the low. So it might be up. In other words, the close will be above the open, but the close will be nearer the low. So imagine that left-hand bar and slide that close lower down, closer to where the open is, closer to where the low is. So the price has still gone up for that period. It might be up 2, but it was up 10 at one point. Now it's just up 2. So it's up, but it's not up at the close as much as it was. Why? Well, because clearly there's some evidence that sellers have come in. Now, unless you looked at the distance of the close from the high and you measured that, you wouldn't actually know. You'd just say, oh, the FTSE's gone up today. Must have been a good day. The so-and-so stock has gone up today. Must be still interest in it. Must be buoyant. You're holding on. Unless you measure how far that close price has gone from the high, you don't really get an indication of whether or not the momentum is slowing. So the ball is still rising, but it's slowing down, about to stop and turn and fall. Similarly with the price, it's still rising, but it's about to slow down, stop, turn and fall. So how do you do that mathematically? So they came up with various formulas of measuring that. Some measured it based on the distance from the high to the close. Others said the distance of the high to the close relative to how it had been a few weeks or days earlier, and so on. Some said, well, in relation to the height of the entire bar, what proportion of it has it conceded, and so on. They came up with all sorts of clever ways. And we don't need to worry about those clever ways. We just need to know the underlying principles, and we need to know that there's some clever maths behind it. But I'm not going to take you through the maths because that would not be an efficient use of your time. I'll show you the formulas so you know that they exist, and I'm not just making it all up. And you can see that, but you don't need to know how it works, why it works beyond what I've told you, because we want to get on with trading. We don't want to be mathematicians. So let me give you an idea. So this is Imperial Tobacco. Random stock, picked at random. The idea is that when it's rising in price, that the high of the day is near where the price will tend to close. And when it's falling, so look at the black bars, which are when it's gone up. See two strong black bars, and you see that the price has closed near the high for those. And then you see the red bars, and you see the price has tended to close near the bottom of those. So that's the idea. Something's losing momentum. As a fact, on Imperial Tobacco there, you didn't really have a clue of a massive turnaround in the price, but the notion is, while it's going up, it should do that, and it should, when it's falling, go down. But in actual fact, what it should do, when it's doing it really well, is give us an advance warning by going up, higher each period, but closing near its low increasingly. What this picture tells you is, like all these indicators, sort of there's something in it, but we're going to have to interpret them very cannily because it's not going to be 100% accurate. It's not going to, reality is not exactly the same as the theory. So how are we going to interpret it so that we can trade and make money off it? And you'll have seen these kinds of complicated images, and some of you will know exactly what the rules are for the MACD. Look at the bottom half of the graph. You will know that supposedly it's a buy signal when the blue line crosses the red line from underneath and below the horizontal zero line, which is here, and that if the MACD is in the upper half, then it's overbought and likely to the price is likely to change direction. If it's at the bottom, it's oversold, and all these things. And you'll know that what these lines represent, that each is an exponential moving average based on different periods and so on and so forth, and et cetera, et cetera. And I'm going to explain these to you, but you don't really need to know. But you'll also know that there's certain rules with this. As I said, a buy signal is if the blue crosses the red, and a sell signal at the top is if it does the opposite. And in theory, that should work well. In practice, of course, it doesn't. So I'm not going to go through, because again, we've got an hour, so I'm going to save you some time. I'm not going to go through what the textbook rules are. You can find those out yourself. I'm going to go through what actually works instead. And I've explained why it should work and what these are depicting and how they're depicting momentum, because they're measuring in some way where the price is closing in relation to its high and low points, and it's doing it by doing a moving average of the share price. Well, what's a moving average? For those who don't know, it's the average of the price over the last 12 days, and the reason it's called moving is because obviously each day it's an extra day, so the last 12 days and then the next day it moves forward, so the last 12 days then and the last 12 days, so you get a line which is moving. So it's the average of the last 12 days, let's say, but it's moving. That's a moving average. Straightforward, simple, but we don't need to know all that. And then you'll know there's lots of rules. I gave you the crossover example that I told you, overbought and oversold. There's a divergence rule. I'll come to that later. The moving average convergence divergence indicator is calculated by subtracting blah-de-blah-de-blah. Don't really need to know that. I'll tell you what you do need to know in a second. So I've mentioned already the cross and how these are supposedly buy and sell signals, but they don't end up making as much money if we follow them. In fact, you can backtest these on computer systems, and they have been backtested, and it doesn't really generate a profitable system. Otherwise, we'd just do a backtested algorithm of this and just have it go along and just make lots of money on it. So here it is again, as a reminder, doesn't really make as much money. What's the problem with it? How do we resolve it? How do I use the MACD? This is the FTSE 100, you can see. I picked a random period from history. The fundamental problem tends to be with the MACD. It's a good indicator. I'll tell you how, if you use it properly, it's a good indicator, is that you can get the false rise. If when you see a price rise like that, you might think to yourself, ooh, should I get in? Now, if you look at the MACD, hasn't given you a signal. So you might say, well, I avoided false signals. Great, the MACD is fantastic, isn't it? Problem is, by the time you do follow it and it has that crossover, as you can see here on the right-hand side, it's a bit late, because by the time you got the signal, you have to wait till the end of the period and then enter the next period. And by the time you enter there, a large chunk of the move's gone. And to be honest, by the time you've exited, there's no point comparing it from the entry point to the theoretical high. You'd never get out of the theoretical high unless you've got 20/20 vision. So what you'd end up doing is losing a bit. Well, you'll probably end up breaking even at best, or losing a little bit of money, because it's given a signal too late. And that's the fundamental problem with the MACD. It gives a signal too late. It's a lagging indicator. It's too much of a lagging. It promises to be a leading indicator. In other words, lead you before a price move, but in effect it ends up being too slow and a lagging indicator. So how do we resolve that problem? Because if we get in too early, then the price rises and it's given us a false rise. So that's no good. What do we do? Surely there's some way we can use it, and there is. One of the critical things I look at, even though I'm looking at the daily chart, I will flip across, and for convenience's sake, I've put here the weekly chart. So I'll flip across to the weekly chart. I would never look at entering in to a daily trade on the daily chart unless I look at the longer term time frame, in this case the weekly, and for instance if it was a 1 minute chart it'd be the 5 minute, and so on and so forth. I'm looking at the daily chart, so the weekly chart, which is 5 days ahead, 5-fold time difference. I would never enter into a daily trade if on the weekly chart the MACD isn't at least flat. If it's falling, I will not go long on the daily chart if the weekly MACD is falling. Now you might say, well, whoa, why is that? And the real reason for that, don't worry, I'm going to write these rules down, and we're going to, for those who are signed up to arpishpatel.com, which is free, you'll have this webinar recorded as well. The reason is that the weekly money, which is slightly longer term money, it's like an ocean wave. It's coming at you, and you can only resist it so long on the daily chart. So that's why you get a lot of false moves. You get, as soon as a little bit of the daily sort of weaker soldiers come in, the bigger wall of money from the weekly traders, the bigger longer term traders, pushes it back. That's what the MACD is warning me. So I would never on a daily chart, which is here, so look at the daily chart, even if the MACD is flat on the daily, and that's my rule, by the way, it's rule number 1, I've got to at least, I'm not saying it's a buy signal on the daily that the MACD is flat, I'm saying rule number 1, the MACD must at least be flat or rising, flat or rising, but not falling on the daily, and same on the weekly. The MACD must be at least flat and not falling. If the MACD is flat, and it would have been at this point on the MACD, because remember at the point that I've marked on the chart, I can't see what's happening thereafter. All I can see is, oh, it's flattened. Once it's flattened on the weekly, I'm looking at the daily, and I see that as soon as the weekly is flattened, and the daily, of course, by then is flattened, then I'm thinking, right, I'm interested. It's still not a buy signal, because the buy signal should never, ever, ever, that just means the conditions are right, but the buy signal should never be determined by what the technical indicators have been doing. It should always be determined by what the price does. Only once the MACD on the daily and the weekly is flat do I then, and there'll be other rules, I'll come to them in a second, do I then enter if the price makes a new 1 or 2 day high? Well, what's a 1 or 2 day high? Well, it means here on the weekly I've got a flat. Here on the daily I also know it's a flat. What I do is during this period I say, right, as soon as the price clears a 1 or 2 day high, I will enter. That means I don't even have to wait till the next day, because I can enter it intraday. I know during the day when it's made the highest it's been for the preceding 1 or 2 days. And then I enter. So I can enter sooner. I can avoid some of the traps like these, because look, it was falling, and that's why that was a trap. And this was a trap because it was still falling. It was still falling here. And I can start then looking to get in, but only if the price moves up. Because even though the daily and weekly MACDs may be flat, trust me, unless the price makes a 1 or 2 day high, you still will get false signals. So I've cut back the number of my false signals dramatically. Still not 100% right on every trade. So that's the MACD. How can I be even better than just that, than just what I've described, making sure the daily and the weekly MACDs are at the very least flat when the price is falling, and I only enter on the price making a 1 or 2 day high? Well, this is where the stochastic comes in. Now, the stochastic has similar rules of being overbought, oversold, the crossover that I described in divergence I'll come to. And it has these things about percentage Ks and percentage Ds. And people ask me, oh, what number do you use for these? And how does it work and all the rest of it? Well, I've given you the underlying principle behind MACD, stochastic, and RSI and what they're trying to measure. And the formulae don't matter. In fact, the numbers that you put into it in a way doesn't matter, because whatever numbers you put, out of 100 stocks, some are always going to show on that buy signals and some are always going to show sell signals, and the numbers will just vary. If you critique in the numbers, it'll always be the same proportion that you'll ignore, and some stocks that you'll ignore because they don't show any signals, and some that you will look at because they do. So I don't worry about what figures are in. I just tend to use the default settings of whichever charting software I'm using, or brokers' websites' free charting that I'm using. So let's look at the stochastic. You've got the percentage K, which is called the fast stochastic, and the percent D, which is called, which here we've got down as both down there as fast. You've got the slow and the slow here. And the difference between the slow and the fast is, as I've mentioned here, is basically just the periods of time they're looking over. Again, we don't need to worry about it. All we need to know is, well, what are the rules, textbook rules for interpretation? Guess what? Come as no surprise, I'm not using the textbook rules, but I'll tell you what they are. When you get the crossover and it's in oversold territory, so when it's at the bottom fifth of the chart, the bottom 20% of the chart, and the blue line crosses over the red, or vice versa for sell signals, that's supposed to be a buy signal. Well, what's the problem with the stochastic then? Why can't we just use that? Problem is, it gives a lot of premature signals. Remember I said earlier, price could still be falling and we get a little bit of a move up and it all of a sudden gets all excited. It's premature. That's its problem. It gets premature or false signals. And it gets us out too early. So you might say, well, wait a minute. Slow stochastic is smoother with less false signals. You're right, less false signals. Still too premature very often. Now, I'm going to show you all examples of where it doesn't work. You'll have got a lot of those from experience or from reading the textbooks. I'm going to show you how actually to use it because, like I said, time is short. Before I do, I'm going to combine with the RSI. Now, the RSI is problematic because it is even more premature. It gets excited like crazy. It gets so excited. In theory, it should work. Of course, in practice, anybody who's tried it, it's a pain. So how do I use the RSI? I tend not to. I know I mentioned it. I know I told you, but it was there to tell you. Just because it's in a textbook, just because it's a momentum indicator, doesn't mean anything. I tend not to. Sometimes on my chart, really don't bother looking at it. Same rules, formulae, same thing. No, way too premature. It's all over the place. It's like a crazy child. What am I supposed to do with it? Look at this. Goes down, goes up, goes down. How am I supposed to use any of that information? Can't do it. Can't use it. Can't use it. So that's the RSI. Look, you see an example. Cons, too fast. Just all over the shop, telling me to get out, get out, get out. Yeah, well, okay, could be good there. When was I supposed to get out? When was I supposed to get in? Too complicated. Some people might have worked out a great way of reading it. Good for them. Good luck. Not me. So what happens if I combine the MACD and the stochastic to improve my predictions even better? Remember what I said. I want the MACD to be flat. I want the price to make a 1 or 2 day high. I also want the stochastic to probably have started rising. That's the first sign that the stochastic's rising, but it's not enough. It's not enough because it's premature and it gives false signals. As soon as the stochastic starts rising, I start looking at the MACD. Unless the MACD is flat to rising, I ignore the stochastic. Notice that. Unless, well, first thing, the stochastic is rising, I'm interested. If the MACD is flat to rising, I'm very interested. I'm looking at the weekly chart as well. Remember, that's got to be flat as well. Then, if the price makes a 1 or 2 day high, I'm looking to enter. When do you exit, Alpesh? Well, exit's a separate webinar, but I might exit at a 1 or 2 day low, or if the MACD is flat, and then the price makes a 1 or 2 day low. And that's most often what I do. The MACD has to then go flat, and the price has to make a 1 or 2 day low, and then I get out, which incidentally is around this point. So we're getting in closer to the bottom, avoiding more false breakouts, and we're getting out closer to the top. The MACD goes flat, only then am I interested, and the price makes a 1 or 2 day low, and I get out. I don't wait for it to finish making that 2 day. As soon as it goes, intraday, as soon as it goes beneath a 2 day low, so let's say it was here, it would be there, or here, I would look to start. I would have put that order in already at the start of the previous night and said if it goes below the lowest price it's been for the last 2 days, then during the day, get out. I don't wait for the end of the day where it could have just gone through it and killed me. Now, so what are the cons? MACD overrules the stochastic, as I said, when rising sharply. If the MACD is rising sharply, I don't care if the stochastic falls. That's not a sell signal. If the MACD is rising, as you see it doing here, doesn't matter. That's how we avoid the downside of the stochastic giving false signals. Because as you'll notice, stochastic can keep on being overbought and going down and down all the time. If the MACD is rising, I don't get out of it. Once the MACD goes flat and the price makes a 1 or 2 period low, then I'm willing to get out. Avoiding premature stochastic and lagging of the MACD by the MACD being oversold and moving sideways, it's flat, but may not have broken the signal line. The MACD doesn't have to have gone above its signal line. It just needs to be flat. Stochastic is usually already rising. I prefer divergences, which I'll show you in a second. I prefer breakouts where the price is broken out from a downtrend. Of course I do, which are the ones I've shown you. And don't forget the weekly chart as well. So let's look at some examples in a second. Don't enter if the MACD is falling, even if the stochastic is bullish. Where's the stochastic? And it's showing a bullish divergence, which I'll come to in a second. If the MACD is falling as it is here, that rules the roost. It is the most important. You do not go long when this MACD is falling. That is a simple rule. Even if the price rises, like it did here, you don't care. Don't care, even if it goes up. Because if the MACD is falling, guaranteed that price is going to, you can sell into strength and short if you want. That MACD will give you the clue what's actually going to happen. Also, avoid charts that just don't work. You know, when you've got charts which are like this, which are just bobbing around quite a bit, avoid those. Side issue. So what's a divergence? A divergence is this. When the price makes a higher high, like you see here, but the MACD makes a lower low. What that suggests is that the next downward move in the MACD when it's flat to falling will be a sharp price move. So the price made a higher high, as you can see, peak to peak, and peak to peak, the MACD had already started making a lower low, so you know to get out. Made a lower low, you know that's going to be a bigger move, a longer move, the second fall, that fall. Now you don't need to start thinking about it around this point when it's already quite early, and that starts giving you the clue because it looks like there's no way, given where the price is, this is suddenly going to shoot up the next day. So it looks like it's going to make a lower low. You get yourself set. If it goes to a 2-day low, you're short. And guess what? The stochastic starts moving lower, gives you that clue. The MACD is flat. The stochastic's lower because the MACD's a laggard. Stochastic's a bit too premature. So you say 2-day low, bang, you're in, you're short, and you're in a profit. So just a reminder what those divergences are. Price makes higher highs. The MACD makes lower lows. And it tends to be that the price falling off those lower lows tends to fall more sharply and a bigger downward move. So let's look at some examples. Let me walk you through some actual examples. I know I'm cramming a lot into an hour, but I want it to be efficient for you. It's going to be recorded for you, but I want it to be efficient and effective to get you into avoiding some of those poor trades. Let's say you're looking at this situation right at the sharp right-hand corner of the chart. This is what we looked at today. Let's say it's today. This is what we see. We see a MACD flat to rising. We see the stochastics already risen. We're interested. I would say price goes above that high for today, then tomorrow morning I want to get in. I put a buy order just above today's high. That's what I do. What happens? I move forward, bang. Of course, it gets hit. We're in the market. We got in just above yesterday's high. So we got in and we got all of today's move upwards. We knew what to do. We knew when to do it. We move forward. What's happening now? Wait a minute. Price seems to have got off a bit. It's had a couple of days where it's not gone up on day 4. Am I worried? Other people might be, but I'm not, because I'm looking not at the stochastic alone, which is falling, and those stochastic traders will be thinking, oh, crossover, better get out, better get out. No, I'm looking at the MACD thinking, that still looks strong. I'm going to stay in. I'm going to hang with it. And I was right to, because when I fast forward, it continues going up. I stayed in, unlike just the pure stochastic followers, because I saw the MACD rising, but now the MACD is flat. Now I'm starting to get worried. Now I'm saying, goes and makes a 2-day low, I might want to get out. Hasn't done it yet. Okay, but that order's there. My God, the MACD is now falling and the stochastic falling a lot. Surely this price can't keep on going up. 2-day low, I want to get out. I really want to get out. Let's see. Ooh, bang. It does. I don't have to wait to lose all of this. I get out just beneath that 2-day low. So I got out quite near the top because I put that order in because I was expecting it to happen, and it happened. New position. Now what do I do? Look at this. Shall I? Shan't I? Well, I've got a pretty good idea because I looked at the MACD. Then I saw this position happening later on. MACD was coming off a bit. I placed the stop loss at the 2-day low. Bang. Exactly good thing to do. I don't have to hang around and wait. Don't have to be indecisive. I know what to do. Got out. And that's the case with examples. I've put more examples here. I don't need to go through it. I think I've made my point with it. My point being how you use them in combination. I showed you how to use the MACD and the stochastic. I showed you how to use the daily and the weekly chart. What I do want you to do, it's all free. Sign up for alpishpatel.com. I know it said fx.com because there's lots of free videos in there. Lots more education like this is going to be on there over and over again. I'm going to be doing quite a few on the future webinars, and some of them are going to be about commodities trading, stock trading, and there's lots of free videos. Everything on there is absolutely free. My aim is, after this credit crunch, is to educate as many people as I can on investing, and I'll have webinars like this on who wins in FX and so on. This is an example of some of the future webinars. So do sign up there. Also, if you want my monthly trading newsletter, you want my views in your inbox, you want a signed copy of my book, you want a CD, What Winning Traders Do, research I use from places like Goldman's, Coutts, Rothschilds, free access to my seminars, webinars, and so on and so forth. And for those who place 500 trades but do trade responsibly, want a free iPad and full-day courses, which are going to be coming soon, then drop me an email. There's my email address there. Once you open an account with any of these and place your first trade, we've done our due diligence and vetted as best we can, given how pointless it is saying that you can trust the XYZ broker. But these are the ones where we've actually met the chief executives, looked in the whites of their eyes, looked at their outfits, and we think they're okay. alpishpatel.com/ETX or alpishpatel.com/capital spreads, or for FX, you can see it at alpishpatel.com/live. Click on those, open an account, place a trade, let me know. You'll get the monthly trading newsletter that I do, my views in the inbox, signed copy of my book, my CD, iPad on those number of trades, my research, and so on and so forth. I hope you've enjoyed it. I'm going to take some questions and answers now. I know there were some questions coming in during the course. I've discovered I'm a useless man. I cannot think and talk and read questions. I'm going to read them now. Where would you put your stop? I think I answered that. 2-day low. One can always Google MACD if one wants to know how it is calculated. Absolutely, Jay. Perfectly. Exactly. I wanted to be efficient on this. When you place your trade, if the MACD is looking good, say, do you look to economic news coming out before placing the trade, i.e. non-farm payrolls? If you place, no, it's a great question, Scott. Actually, what I do is I might put in my mind, I think there's some good news. I can see how this is reinforcing the momentum. In a way, what you've got to remember is the MACD is not independent of economic news. It is a consequence of economic news and all the sum total of market intelligence. So you mustn't think, oh, my MACD's got a buy signal and economic news is a buy signal. They're not independent. They're somewhat overlapping. So I've got to bear that in mind. Can you define what you consider a breakout? Teresa, I'm going to do a separate webinar on breakouts, but breakouts essentially is when there's a downward trend line and the price has moved above it. But I've got to do a separate one on that because it's a bit complicated on that. What charting packages do you use? I either use it on those free on those brokers that I've just listed there, and these charting packages are free on there, or I use ShareScope as well. So that's a couple of the things on there. Alpesh, when trading intraday, are there any times of day you avoid? Brilliant question, Martin. Yes, I forgot to mention, first 30 minutes on the LSE is exactly it. It's too volatile. Prices are still being determined. I try not to. I also prefer, by the way, indices and foreign currency for trading technicals rather than equities. And the reason is technicals were invented to be used on indices and Forex. They tend to work better on them in my experience than equities. I should let you know that. Hi, Alpesh. Is there a best time to trade? I found that the US market post-open always gives good prices. Any thoughts? You've done it exactly right. The US post-open, not bang at the open, post-open starts being good, and the US markets tend to be more liquid, and therefore the prices tend to be smoother, and therefore the technical indicators tend to work better in my experience. I can't find the library of your previous webinars on your website. Jim, have a look at alpishpatel.com/webinars. I'm going to look into that because I have a few people say they can't find where the past webinars are. So I'm going to look into that. But if you go to alpishpatel.com/webinars, you'll be able to find them as well, more easily probably as well. Now, let me see. How often do you trade and what typically timescale intraday swing? I used to trade more actively until I started the asset management company, which takes up a lot of my time because what we do is we're an FSA regulated asset manager, and so that running a business at the same time as trading. I used to do intraday. I used to do on futures a lot more. I still occasionally do, but time usually doesn't allow me to. So now it tends to be swing trading, which means holding for weeks. And sometimes it tends to be buy and hold based on fundamental analysis, and I'm going to do webinars on that as well, where I'm looking for holding for things for months or 9 to 12 months or over a year. That's based on valuations, and that tends to be discount cash flows rather than technicals. Backtesting. My research shows trades work better when the indicators are above 40 as opposed to between 0 and 20, what the book says. Great, Terry, exactly. The books tend to be wrong. I've seen people talk about hidden divergence. I don't know what hidden divergence is, Philip. Sometimes people do come up with names just so they can sound clever in these books and these seminars. So it might be one of those things, when they say hidden divergence. I've read pretty much every book on technical analysis, unless my memory serves. I've not come across that. Do you check the sector? I don't, Jay, and the reason for that is, there's a lot of things I could end up checking and doing. I look at time efficiency, so I don't. What about on shorter time? For example, use the example with M1, M3, and M10, but MT4 only has M1, M5, and 15 without using a period converter. Would these 1, 5, and 15 minutes work as well? Exactly correct. Absolutely perfectly correct. If I'm looking at the 1 minute chart, I look at the 5 and 15 as well. And I think of the 1, 5, and 15 minutes as the equivalent of daily, weekly, and monthly. And that's how I look at it. Lunchtime, I'm not sure what that means. What about MACD Forest? No, I don't look at that. I look at the lines, and that's just personal taste. By forest, you mean the bars. I don't look at that. When entering a trade, what percentage of your capital do you risk per trade? Perfect question, Jason. 2% of overall capital between that and my entry stop loss. But I'm going to do a separate one on money management. They're also on my website on money management. I've covered it before, but I will do that as well. Unfortunately, I missed the webinar you did for ShareScope users the other day. Is that available anyway? It's going to be available, Jim, on the ShareScope website because it was just for ShareScope. It'll be on their website as well, sharescope.co.uk. You'll be able to get it, and I've had lots of praise for that one. Because it was done for them, I've not, obviously out of courtesy to them, put it on archpatel.com, but it'll be on sharescope.co.uk. Would you recommend taking short following exit of long position using the MACD and Stochastic if the trade's there? Very important point. Just because I might have entered in a trade doesn't mean I've got to keep on trading that instrument. I've got to pick the best ones. So I treat it as if it was a fresh trade. Avoid trading at lunchtime. Jay, I think that's a fair point. How about RSI trend lines? Nope, don't look at them. As I said, I actually ignore the RSI. What are your favorite things to trade? Great question, George. Liquid instruments when it comes to technicals. Things like the FX, things like indices. Jim, I've looked at it on the ShareScope website. Jim, I'm going to email Tim just in case he hasn't put it up yet. I saw him this afternoon at ShareScope, and I'll ask him if it's why it's not the other one isn't up yet. Do you use candlesticks? Nilesh, I do occasionally. I do like them. I just love the whole theory behind them. I like the patterns, and you can. It wasn't the space to do it in this webinar. You can augment and corroborate your indicators by using candlesticks as well as independent verification for what's going on. But again, remember, they too are just reflecting what's already there as well. Guys and gals, I'm going to answer another one. Do you short the index commodity share when your method tells you to exit a long position? No, you don't. An exit isn't a short signal. They're two different things. A short, the same rules apply as longs, but you just do it in reverse. I didn't want to, again, waste time by saying exactly the same, but in reverse. A short is that you don't just short it, you exit. There's a difference between shorting and exiting. And shorting is the same as a buy signal in the opposite direction. Do you have any plans to have a live webinar during the day, say FX, to show you trading live for a period of time? Terry, I have looked at that actually, and I may well do that, even if it turns me out to be a fool and I get a really bad run of just losing trades and end up going, oh God, oh no, that one didn't work, that one didn't work, that one didn't work. So I do plan to do that. It's just that during the working day, I am incredibly busy because I'm not just placing trades. In fact, nowadays, because I'm doing the longer term trades and running the business, I'm actually running around in meetings and so on, rather than just placing the trades, unlike, say, 5-10 years ago. Japanese candlesticks with Western technicals, yin and yang, exactly, Morgan. I think, they work well. Where do you see the markets going right now? Are you long commodities at the moment? How do you see the next 2 to 3 months? Raza, that one is answered on my ShareScope one, my sharescope.co.uk one, which will be up hopefully tomorrow. on their website. In the short term, and I said it before in my other webinars, I always said I see May being negative. Actually, I see April being negative, but the earnings held April up, and therefore we're seeing May being even more negative. But I am bullish for equity markets till the end of the year. It's just that I said until at least June, and I'll revisit in June if I'm going to be bearish beyond June. But I just see a few months of it going down. Do I use stops? I do, Martin. And the types of stops I use, which tend to be essentially 2-day lows, or get out 50% of the position at 2-day lows and maybe 50% at a 3-day low. I'm going to do a separate webinar on because it's a complicated subject, and I'm also going to do a separate webinar on the average true range, which is a volatility-based stop on which you can also incorporate your money management rules. It's actually simpler than it sounds, and it's a brilliant way in which to trade. Evenings will be fine for live FX. Terry, yes, indeed. And I've actually done live trades before as well. Limits, and I will definitely look into that. I'm actually planning to do one out of Hong Kong where I'm going to give the view from China, and that might be the best time to do one there. Lots of questions coming through. Limit orders. Yeah, you know, Martin, when I know that if it makes a 2-day high to enter, then I'll place that as a limit order onto the system and just let it execute because then it'll buy me into the trade as well. Is the Greek debacle going to be a black swan event? Is a default in the pipeline? That's why, two things, Jason. That's why I think these technical indicators give me a heads up that equity markets are going to be weak for the next couple of weeks, couple of months. So I already knew beforehand that something's going to crash. And also it's why I did the ShareScope webinar. It's free on their website, by the way. I know I keep referring to it. In that, I did that and explained that I need stocks for the long term, which are going to weather such black swan events. They're going to happen at some point, extreme events, and I gave some figures on those of which stocks I like based on discount cash flows and a methodology called cash return on capital invested and names of specific stocks. Do you see the US presidential elections? I'm going to answer that separately on a separate one because it's a long question. Link to your ShareScope webinar is on APSI page. Brilliant, Ivan. Thank you, which means it must be on Alpesh Patel, sharescope.co.uk/Alpesh Patel. Must be on there. Do you see the weekly as a buy even if the monthly is turning as we have at the moment? It's a great question, Jay. If the monthly is turning, I get worried about the weekly. I still see it as a buy, but if the monthly is turning, I know I'm walking on eggshells, I'm walking on thin ice. Because it could turn. Are you on Twitter, and do you have a link to the ShareScope webinar? I am indeed on Twitter, and I think I'm Alpesh P1. Sorry, it's a ridiculously useless sort of Twitter name, but I never sort of thought about it when I first got on, and then it was too late because lots of people follow me. So it's Alpesh P1. I'm trying to write it down, but for some reason I am not being able to write it down. Here we go. Are you on? Yeah, so the ShareScope page I will send to all of you is ShareScope. .co, where the other webinar is, and I have to say it was one of my best, if I say so myself. It's that one. Might be /Alpesh as opposed to Alpesh Patel. That's the ShareScope one, and my Twitter, on which I do put clever things occasionally, including research, is, I think, Alpesh P1 as well, though I should actually, in all strictness, check those and put those up before. Do you use EMAs on the chart? No, I don't. I know they were there, but I don't use it. Perfect. Thank you very much, John, for providing that one. What it is indeed Alpesh Patel on that. So everyone, I want to thank you all for listening and being patient. I know it takes a little bit of time for me to get these up because they have to be encoded by the IT people before they go up, but they do end up getting up there on alpeshpatel.com as well, and we'll make sure that the links are even more clearer in future. So I want to thank you all. We're going to have lots more webinars like this. and I hope to, and thank you for everybody who's following me on Twitter. I very much appreciate it. I also happen to be on Facebook if you want to be on there, and I think there I'm Alpesh BP. So again, feel free, and thank you for all your kind messages coming through as well. They're always much appreciated. So Facebook is Alpesh BP, if I'm not mistaken. So thank you all, wonderful, and thank you for the compliments. As I say, they're always well appreciated at the end of a long day for everyone. And I will put up more webinars, and I will give you all emails of when I'm going to do them, where they are, and what they're going to be on. And if there's any subjects you'd like them to be on, please just go ahead and write it right now, and I will make notes of that and try to cover all the subjects that I can. I certainly will do things like limit orders and money management and stop orders and how to use those for profit. But I really appreciate it that everybody's taken the time to come in. And of course, you can always tweet me as well, and you can always email me with any questions as well. There we go. arpesh4@me.com is the email as well. So just wanted to thank you all. Thanks everyone. Good evening.